I've been going through the past year papers. I think I have like a good overview of the module and understanding as well. But when it comes to the long questions in the exam papers, I'm struggling a little bit with specific like sections or
Okay.
topics.
What examples
Yeah.
do you want to go through then? Which sections or which questions?
Okay. So one of the issues that I'm struggling with is factoring.
Okay. So selling your debtor's book.
Yes.
All right.
So I noticed in the May-June 2016
May, June 2016.
paper,
Okay, let me open that one.
yes, it's question one.
May, June 2016. Okay. May, June. So this one. All right. Let me just bring this across so you can see it. Okay, so here's the paper. Is this the right one? Eh? May, June 2016, 70 marks. Same one that you were looking at.
Yes.
Okay, good. I'm just going to open up the Excel spreadsheet as well, just so I can show you the working. So you have a question about the first question, so let's have a look. Answer section A and B. Section A, 30 marks. Okay, this is multiple choice.
Yeah, so the multiple choice is fine for
All
me.
right.
It's the
The
section
long one.
B that, yeah.
Okay, this is it. Okay,
Yes.
distinguish between factoring and pledging accounts payable. This is actually a theory question. So this question is looking at the difference between factoring and pledging accounts receivable. So when you're looking at working capital management, remember you need to have sufficient capital on hand in order to meet short-term obligations to continue operating. So working capital is looking at your operations, in other words, your day-to-day, your short-term. So if we're looking specifically at factoring, factoring is selling the debtors book. So remember, when you offer products or services to customers or clients on credit, there's going to be a debit for the debtors. Right, your debtors are going to owe you, your debtors are going to have to pay you at some point in time in the future. Right, so if you're looking specifically at factoring, okay, you're actually going to sell your debtors book. So maybe you have, I don't know, let's say 100 million that's outstanding, and your business wants to collect that 100 million quicker rather than have to go follow up. All right, and the business might even have to employ a whole department of people to go follow up with those clients or customers, to send them statements, to call them, etc., to get the collection. Right, and that's factoring. So factoring is be, well, okay, I've sold 100 million in terms of sales. Obviously, you would have sold all those products and services at a profit, and that profit could be quite substantial. So you could say, well, okay, I'm already making a profit on the sale itself. Can I take a discount in terms of the amount that's outstanding to sell this to a debt collector who will then go and follow up and collect all the outstanding debts? So that's what factoring is looking at. Pledging is the opposite. Pledging is not selling your debtors book. You keep the debtors book. It's your asset. Remember, accounts receivable, debtors in your book is an asset. If you're pledging your accounts receivable, the pledging is using this as an asset to secure finance, so to get a loan. Right, so let's assume you have 100 million in terms of outstanding debtors. You could go to a bank and say, well, banker, I've got 100 million here that I'm going to be collecting in the future. There's obviously going to be cash flow from that 100 million because you're going to be collecting outstanding debtors. So there'll be cash flow each month when you collect. And you can say, okay, well, there's the situation. I'm going to pledge. In other words, I'm going to use this asset, this debtors, okay, this accounts receivable, and I'm going to use it as collateral and say, okay, well, I've got this asset. I'm going to be collecting outstanding debtors each month. If I can't collect or if I default on my loan, then the bank will obviously use that as a form of collateral. So pledging is more using it as a source of how can I put it, like security for more
Yes.
loans. That's the theory that you'll see in the textbook. The factoring
Okay, so
calculation,
factoring is, sorry.
yeah.
So factoring is not actually using it as collateral,
No,
correct?
factoring is selling the debtor's book. the pledging of accounts receivable, that would be using it as collateral.
Okay.
Okay. All right. So I've got a page number here. I see page 637. Where's the textbook? Oh, let me just quickly get the textbook. I see it's on the other table there.
Okay.
All right. Okay, so in the textbook, factoring would be covered in the section looking at, you've got section 6, short-term financial, current asset management, chapter 15, probably. Or, is there anything else?
Chapter
Current
16.
liability, current liabilities management, chapter 16, 621, possibly. Okay, let's check
I think
635.
it's 637.
637.
Yes.
635, short-term loans. 637, yeah, using trade receivables as collateral. Yes, okay, that would be a pledge. Right, the pledging process. All right, factoring, you can see on the next page, 637. 636, you've got the collateral part, and then 637, you've got the factoring part, yeah. Okay, right, so you're probably looking at the next question then. So theory, is that all right?
Yes, so that gives me a better understanding.
Okay, yeah, so that's just two completely separate topics. If you look at the textbook, right, they've described factoring involves selling them outright at a discount to the financial institution. Do you see that?
Yes.
Okay, versus using trade receivable as collateral, where you're going to pledge your trade receivables as security for more financing in terms of getting short-term finance. Right, calculating the cost of factoring for this company. Right, so if you're calculating the cost of factoring, factoring means you're going to sell this debtor's book. All right, so I see I've done the working here, so I'm going to put it across so you can see it. Okay, so this was the answer that I've created. Let me explain it to you so you can understand what I've done. So for 1.2, you're looking at the factoring calculation. Obviously, you're looking at a cost. Right, the cost is going to be like, what are you actually going to be incurring, okay, when having completed this this deal with a factor. Okay, so the factor is obviously going to purchase your outstanding debtors, and they're basically going to say, well, give me your outstanding debtors, I will go collect the outstanding payments, but whatever I collect, I'm going to keep. Okay, and obviously they're going to pay you a certain amount of cash or capital up front, and that's going to be your proceeds from the sale, basically, of the amount. Let me go back to the question. Okay, if you look at the question, you can see question 1 says, the Study Guide Limited Company, okay, is a BE company dealing with stationery. Okay, in 2015, the company made 400,000 in sales. Right, so you can see that they are selling goods on credit. Okay, that would be your debtors or your accounts receivable. Then during the year, the company was offered the following terms by a factor. Right, so you've got two separate considerations. The first is 75% of each invoice could be drawn by the company immediately on presentation. Interest would be charged at 1% above prime, and the service fee would be so this is not 15%, it's 1,5. I don't know why, but for some reason, in their past papers, they don't put a comma here, which is weird. But that was something that was noted. They sometimes leave out a comma. This gap here, this space here, is actually supposed to be 1.5. Maybe it's the scanning or the printing of this document. But anyway, it's 1.5 of sales. The prime rate is 15.5%, and the company's average collection period is 60 days. Well, then you've got another point. If the company chooses to factor, so this would be the pledging, okay? This would be the factoring. Right, so the factor says it would pay its suppliers in time and take 2% as a cash discount. So 2% less 4 million, that'll be less, what, 80,000 I think it is. But we'll check, we'll look at the working. The company's annual purchases amount to 40,000 of its sales. In addition, the full use of factoring would save the company 30,000 per year in employee wages. Okay, so remember we said if the company is going to factor their debtors book, then you don't have to worry about the additional costs that go with at the administration. In other words, you don't have to employ somebody, a debt collector, an internal debt collector, or an internal debtors department to go follow up with all these clients. So you're going to save on costs. Okay, they say none of the employees would be retrenched, so you'll keep them. The company would also save 5,000 per year in telephone and stationery expenses. Again, those are costs that you would save on. Okay, should you get somebody else to go do the debt collection for you. Right, so that's just what we've read. Let's go back to the answer. Okay, all right, so costs for the year. All right, factoring, there's the one part of it. I've also shown pledging here actually, just so you can see both, right? Because when they give you information relating to factoring and pledging, right, factoring and pledging are similar, but they're different. Okay, so I've shown both here because you could make a comparison and you could maybe state whether the one is cheaper than the other depending on the situation. Right, so the current factoring situation, they said, if you're looking at the credit purchases, in other words, the creditors, right, factoring 40% of the 4 million, okay, is purchased, right? So 1.6 million. Okay, that 1.6 million is the actual outflow or payment that's going to be derived, okay, from this particular arrangement. So there's going to be a payment or an outflow, okay? That outflow or payment is obviously what you're going to have to, inverted commas, consider as part of the deal, okay, the factoring arrangements. Right, if I'm looking at the benefit, right, this discount, okay, this discount here is looking at, well, what is the amount, okay, it's 1.6 million, okay, that discount that I'm getting, 32,000, right, is going to be offset against the amount that's going to be paid, plus I'm also going to reap certain benefits, right, because when we read the question, let me shrink this. Okay, the question said here, okay, if the company chooses to factor its debtors, right, 2%, okay, will be a cash discount. Right, so the discount, 2% of 1.6 million. Right, the company's annual purchases amount to 40% of its sales. Okay, so in addition, the full use of factoring would save the company the 30 and the 5. Right, so there's an additional benefit that's being derived from this arrangement that is present. Okay, so if we're looking at the net costs of factoring, so in other words, after taking everything into consideration, right, ultimately, okay, I'm looking at this as an outflow, okay, the annual purchases, right, I'm looking at the benefits that I'm going to derive, so I'm going to offset that in terms of the costs. So if you take this amount and you offset it with those amounts, right, you're going to get that figure. Okay, this figure is representing what you're going to be basically incurring, or what's the word? Incurring is probably the best way to put it, because it's something that you need to provide for in your arrangement that you have with the factor. So the factor is willing to assist you. They're willing to take on that burden, that responsibility. Right, so if we take that consideration, okay, and we're looking at the total, which was that 4 million, which we have in sales, okay, 4 million as the denominator, the 1.5 million or 1.501 million divided by the 4 million gives you this 37.525%. Okay, so in actual fact, it's going to cost us 37.525 as a cost, as an amount that I need to that I need to provide for. Okay, because remember, you're never going to get the full the full 4 million, because the full 4 million is your total sales. That's what you've sold. Okay, what you are going to get from having arranged with this factor is it's going to cost you, okay, the 1.5, right? So in actual fact, depending on how much it costs you to raise capital elsewhere, you might or might not consider this situation. So if you look at the right hand side, okay, with the pledging, right, so with the pledging, I'm going to use it as security for more debt, right? They said that we're going to be able to said 75% of each invoice could be drawn by the company immediately on presentation. Right, so I need to calculate how much debtors am I or do I have, okay, in terms of my collection, right? And based on that number, I can then compare it and then decide, well, is this going to benefit us as a business? So look at the situation, okay? If I have 4 million in debtors, okay, average collection period, meaning every 60 days, I'm going to be collecting cash. I'm going to be collecting money. Every 60 days, I'm going to be collecting that amount of money, basically. All right. If I'm looking at the 75%, so 75% of each invoice can be drawn by the company immediately on presentation. So in other words, I'm going to be securing a certain amount of cash or cash flow each period. That cash flow needs to be accessible, or needs to be like, what's the word? Not factoring, what was the other one? Pledged. Okay, so if I'm pledging a portion of my debtors, okay, that pledge is going to allow me to access more cash, to access more debt. All right, so this portion, okay, what I'm going to be generating, I'm going to be receiving a certain amount of money every single month, or not month, every 2 months, 60 days, every 60
It
days,
makes a little more
okay, a portion of
sense.
those debtors are going to be
I
collecting.
think maybe I just
Right, so
need
that
to
means
go
I
over
can
it again
access
myself and try and
351,781, okay, which
yes.
is what I can actually get from this arrangement. Are there any questions? I don't know if that makes sense. I'm trying to explain it based on the workings.
It makes a little more sense.
Okay.
I think maybe I just need to go over it again myself.
Okay, because let me see if I can find something that can help you. Here, if you look at the textbook, they talk about the pledging cost. The stated cost of a pledge of trade receivables, okay, is normally 2% to 5% above prime. In addition to the stated interest, the service charge of up to 3% may be levied by the lender to cover its administrative costs. Clearly, pledges of trade receivables are a high cost source of short-term financing. Right, and you'll see there further up a percentage of. The percentage determined from this process represents the principal of the loan and typically ranges between 50 and 90% of its face value of the acceptable trade receivables. All right, so a bank or any lender is never, ever, ever going to give you access to the full amount of your debtors in terms of what you're going to be collecting, right? Because they need to also manage their risk. If they know you have made a certain amount of sales, and if they know you're going to be collecting a certain amount of money each month or every 60 days, the collection period, that collection period, that time frame, that's the amount of money that you're going to be receiving as a benefit for having all of these debtors. Right, so they're going to allow you to access a portion of it. So 75% of that invoice amount, okay, of that debtors amount, can be drawn, okay, or taken or accessed, all right, in the form of debt, okay, in the form of a loan. All right, so they need to manage it. So they're not going to allow you to access, okay, the 4 million. They'll never. All right, 4 million is way too much in debtors, and a lot of the time, not all of those debtors are going to pay. Right, so they're going to look at that situation and they're going to say, well, okay, looking at your current situation, okay, as a business, every 60 days, you're able to collect a certain amount of money, right, from your debtor. Right, that amount of money is going to incur a certain amount of costs should you choose to access that portion today, right, ahead of time. In other words, using it as a pledge. Right, remember they said the pledging process, when a firm requests a loan against trade receivables, the lender first evaluates the firm's trade receivables to determine their desirability as collateral. Right, the lender makes a list of the acceptable accounts along with the billing dates and the amounts. Right, the borrowing firm requests a loan for a fixed amount. Right, if the lender needs to select only enough amounts to secure the funds requested, the borrower wants the maximum loan available. The lender evaluates the accounts and selects the maximum amount of acceptable collateral. Right, acceptable collateral, meaning they're going to decide what is the amount that they're willing to take on and give you as a loan. Right, because remember, the 4 million is just fictitious sales that haven't been received. Okay, a bank or a lender or a pledger, or in this case, okay, the person pledging, or not pledging, but the person giving you the loan, they're not going to look at that 4 million and say, okay, well, that 4 million is like, how can I say, it's a definite, there's no risk there. There is a risk. There's a lot of risk there. That 4 million, okay, a lot of it might not even be collected depending on the company. We don't know. This company is only collecting every 60 days. That's quite late. You're collecting every two months. Right? And how much are you collecting? We don't even know. Okay, but it's a rate that we need to consider. Right, so based on the current expectation, okay, the factor would allow for you to access a certain amount of funding. Net cash available from pledging,
Yes.
351,000. Okay, so that's how much I could potentially get from this debtors arrangement, using it as a pledge, using it as security for more capital.
Yes.
All right. Other questions? More questions?
Yes. I think I would also like to go through question 2 in the same paper.
All right.
I noticed that it does come up as well in
Yes.
other papers about the relaxed credit standards.
Correct. Yes, it always comes up. So let's have a look at the. Okay, so 3 things you need to remember. When you read the question, highlight things that relate to those different sections. Okay, so just to recap, you have an example in your notes and in the textbook actually where they talk about your altering of your credit policy, and that's going to either help your business or harm your business, but there's going to be good and bad when you're relaxing your credit policy. Obviously, you're going to benefit or reap more sales, right? That's your expectation, right? And having reaped more sales, you would probably expect more bad debt, and you would also probably expect an additional investment in your accounts receivable, in other words, your debtors. Because think about it. If I'm going to sell more goods on credit, then I need to finance, inverted commas, the products that I'm going to be selling ahead of time, right? And that's that whole investment in accounts receivable, right? So when you read a question like this, maybe use 3 different highlighters or pens, and then just like highlight what sections relate to what. Okay, so you've got K Limited. They're relaxing the credit standards to encourage more sales. Okay, that's a given. Right? If you're making credit easier to apply for from the customer's point of view, then we would ultimately expect our sales to increase, which is the case in this scenario. Okay, they say that sales are expected to increase by 15% from 300 canoes per year to 345 canoes per year. Right, this is sales volume. Right, so sales volume is going to help you determine your revenue. Okay, remember when I'm calculating your benefit, okay, or the good or the bad in terms of the ultimate, the big picture. In other words, you're going to look at all 3 categories. Right, you can see there's a benefit here. Right, I need to know, well, how much do I sell each canoe for, and how much profit am I going to make on the sale of each canoe? And this 45 increase in volume, is that going to offset the other stuff? Right, so if you read the next bit, ACP, average collection period, is expected to increase from 30 to 40. Okay, that's a given. Right, obviously, if you're going to relax your credit policy, you're going to incur more costs. In other words, you're going to have to buy more now and then pay for that later. And your customers are not going to pay sooner, they're probably going to pay a little bit later. So based on this person or this individual's analysis, they've indicated that your ACP is going to lengthen. Right? If your ACP is going to lengthen, you're going to have an increase in your accounts receivable investments. That's the second part. So 2 things. The sales part, the profit, the margin that's going to be derived on an increase in volume because I've sold more canoes. And then I'm going to look at the investment, the additional investment in average in your debtors, okay, based on your average collection period. And then the last thing is the bad debt. Okay, the bad debt, they say, is going to double from the current level of 1%. So obviously 1%, it's now going to become 2%. And then what else do we have? The company's price per canoe is $850 and the cost. Okay, so this you need to do the profit calculation. All right, you're making 200 Rand a canoe in terms of margin profits. Okay, your sale price, 850, cost price, 650. Obviously, the difference would be your profits. Okay, then they tell you that the average cost per unit at the 300 unit level is 700. Okay, so that's at the 300 unit level, which is the current situation. Okay, so if our production had to increase to 345 canoes per year, right,
But it
we're
doesn't
not going to be
specify when it says
the
the
average unit,
price
the
for the
average
canoe
cost
and the
per unit
variable
at the
cost.
300
It
unit
doesn't
level is
specify which.
700. So, and the variable cost per canoe is 650. All right, so this looks like the costs have actually gone up. No, not gone up, gone down if you produce more rather than when you produce less. I'm just reading this.
But it doesn't specify when it says the price for the canoe and the variable cost.
Yeah, because
It
the
doesn't
average cost per
specify
unit. Average cost per unit. Okay, so you've got two costs here. I think I would have made an assumption in the working here. Yes, I did. See, 700 and 650. Okay, because you're looking at two different costs, but it's not specific in terms of volume. The variable cost per unit per canoe is 650, and that's the current situation. The average cost per unit at the 300 unit level. Yeah, so I've done two workings here because it's not really clear what this variable cost relates to, if it's the 345 canoes per year or if it's the 300 unit level. I think that this relates to the 300 unit level, and then the 650 relates to a separate consideration. Okay, that was the interpretation. And then the firm's required return on equal investments is 20%. Obviously, that's used in your additional investment in debtors. Okay. Having read that, does that make sense? Okay, so the first bit is just the profit. That's the easy part. This is where you need to take the cost into consideration. So only for question 1 do you need to consider the 650 and the 700, right? So I've done two workings here just to show it. Okay, so I went with the existing. Existing, in other words, I currently sell 300 units, okay? Obviously, each unit is going to cost 850. So 850 times the volume gives me my total sales, okay? I've also assumed here that the variable cost, based on what we read in the question, if I'm producing 300 units, I'm going to assume a variable cost per unit of 700. So giving me VC, variable costs, of 210. Okay? Notice I'm assuming that this is applicable for the 345 units. So this would be an economies of scale. It's not uncommon to see that happen. Sometimes if you produce higher levels of volume, sometimes you can actually reduce your costs, okay, because you reach a certain level of economies of scale. That's economics. Okay, so economics talks about volume. Okay, sometimes increasing the volume is not a bad thing because then you can reduce the per unit cost. So for example, let me ask you this. If you were baking one cake, right, for yourself personally as an individual, right, baking one cake for you as a non-baker, as you're not running a bakery, the cost of producing that one cake is going to be a lot higher than if you had to go to a bakery and just buy the cake from them, because they have economies of scale. Does that make sense? Yes. Okay, so that was my assumption here. That's why I'm looking at those two. Okay, I've just said, I know this 700 links to that. Okay, I know they're proposing a new plan by relaxing the credit policy to increase the sales volume. Right, so I've assumed that if they increase the sales volume, then that variable cost per unit relates to the proposal. In other words, the increase in units. Okay, which isn't, maybe I should have added more knowledge here or more notes here. In the exam, I would write something like economies of scale, or in the question we're assuming, or we're looking at a scenario where the company's price is 850 and the variable cost is 650. All right. If you didn't assume that, and if you used 700 for both, then the amount would have been a little bit different. But the working is still the same. To get the answer for 2.1, you have revenue, you have costs, and then you have to work out the difference. All right. You can see here that the difference is favorable. Right. You're going to save, okay, 24,000 because, yes, costs are going to go up. You're going to incur more costs, but you're going to make more sales. So the 38,250 less the 14,250 gives me the increase, the additional profit. Okay, so looking at this one scenario, looking at the increase in sales volume, this is looking quite good. I'm going to probably go with it, unless I see something drastically different when I look at the increase in debtors, investment in debtors, and also the additional bad debt that I'm going to have to stomach as a business. Does that make sense? Okay, so yeah, so just be careful with that. They could have been a bit more specific, but it is what it is. I'm hoping that things have improved. Remember, 2016 was a long time ago. I'm sure they would have improved some of their questioning since then. Back then, there were some issues. Things were a little bit vague, and we have raised some of this in the past. So hopefully going forward, things will be a little bit better so that you can specifically say, okay, this belongs to that or that belongs to this, rather than having to decide on your own. Okay. But just follow the principles. Okay, you cannot change the working, you cannot change the calculation. The way they give you the information, that could be a problem, a question mark. But again, you can't alter or change what's given. Just make the most of it. That's why they've given you lots of lines here. So add comments. Put comments in where they need to go before you submit your answers. All right, and then the next one. Okay, this is always the difficult one. All right, when you're looking at the marginal investment in accounts receivable, you need to remember that formula. So go back to your notes and then look at that one slide where I've given you those equations for the debtors collection. Okay, this came up in the credit policy. That was towards the end here. Disbursements. There we go. That's what I want. Okay, I will literally write down these two equations. Do you see that? Okay, once I've written that down, I literally just read the question. The average collection period, I already know it's given in the question. Okay, this gives you an amount, and you're going to insert that amount into your denominator here. Do you see that? Okay, your variable costs in terms of your annual sales, that you would have calculated previously. There's the variable cost. So in the next working, I'm going to use those blue figures. There. Okay. And those blue figures, these ones, okay, are going to be used to calculate the additional investment. Right. And then I'm going to have to work it out by multiplying it by the cost of the investment, the 20%. Right. See, there's the formula that I just spoke about. There's the other formula. Right. So start with this. Okay. No, start with that, okay, because you have the ACP. Where's the ACP? Go back to the question. There's it there. Okay, 30 days to 40 days. Right, so in the existing period, notice on the left, in the existing period, okay, 365 divided by 30 gives me that figure. Okay, in the proposed, in the relaxed credit policy scenario, I'm going to have 365 divided by 40. That gives me that a measure. Okay, so you've got this measure and that measure. Right, once you've got that measure, this thing, the turnover of trade receivables, then you can work out your average investment. Right, this divided by that gives you those figures. Right, so currently, as it stands, in the current situation, I need 70,260 that I have to invest in my average collection period. If I choose to relax the credit policy, then it's going to increase to 24,000. The difference is the marginal, is the extra amount that I need. All right, so you take this, you minus that, you get the difference, you times it by 20%. This is the additional cost that's going to be incurred when relaxing the credit policy. Are you with me? Does it make sense? Okay, so this is positive, 24. This is negative, so minus the 1463. We still need to look at the 2% and the 1% bad debt. Remember that? Okay, and that's easy. That's calculated on the 850 times volume, right? The sales revenue. So if you go back to this, those two amounts, I need those two amounts because that's going to be 2% and 1%. So
Yes.
Current scenario, 1% will be written off as bad debt. New scenario under the proposed policy, I'm going to write off that. So the difference is an extra 3315 as potential downside when going with this change in the policy. Okay, if I summarize, the last question asked you to summarize and make a decision. Okay, plus 24 minus 1.4 minus 3.3 gives you the 19. The net is positive, so the benefits outweigh the disadvantages.
Yes, much
okay,
better.
you're going to get more from this change in credit policy than you're going to lose out on. Right, so the cost of implementing it is not as high as the benefit of implementing it. Our sales are definitely going to offset the investment in trade receivables and bad debts.
Yes.
Is that right?
Yes, much better.
Okay, perfect. Yeah, good question. Yeah, as you mentioned, this is going to come up. It's probably a guarantee, but
Yes.
nothing's really a guarantee. But from what I've seen in past papers, there's always a question about this. Some past papers have
So I
longer
don't know if
questions
this
than
is
others.
similar to
This
what
one
we
was a
just
long
went
one,
through,
15
but
marks, broken up
it
into
is
4 different
also
sections. So lots
it
of
has to do with
marks
the ACP.
awarded for that exam.
It's also a long
Okay,
question.
was there anything else
It's
on this
in
paper? Okay,
October,
that looks like
November
we've covered all of
2018 in
it.
section B, question
All
1.
right. What else?
So I think the part that
What's next?
confuses me is the
So I don't know if this is similar to what we just went
It's
through.
fine, ask.
is that obviously sales
It
is
is also
paid like 30%
it has to
first
do
and
with
then
ACP.
70%
Yes, okay.
It's also a long
afterwards.
question.
Yes.
So I'm not sure how
November
to
2018 in section B.
Okay,
question.
October, November 2018.
So I think the part that confuses me
Yeah.
is the
Yes, question 1.
is that obviously sales is paid like 30% first and then 70% afterwards. So I'm not sure how to.
Okay, so there might be a slightly different way of testing or
Yes.
questioning it.
Yes.
Let's see. Long questions, eh?
Yes.
Okay, the first one. So, all right, here's it. Essay type questions. Both questions are compulsory. Okay, what are they asking about here? All right, so S Limited sells on terms of. Okay, when I see this, I'm already thinking about the cost of giving up the discount. Remember that?
Yes.
Okay. What else do we have here? The firm's total sales are 1.5 million. The financial manager observes that 30% of the customers usually pay on the 10th day and take the discount. Okay, so again, this is talking about the cost of giving up the discount. The other 70% pay on average 50 days after their purchases. All right, so they want you to calculate the firm's accounts receivable period. Okay, so let's think about this. All right, do you agree if I'm looking at a percentage? 30% pay within 10 days, 70% pay within 50 days. Do you agree? This is like a debtor's age analysis, right? Okay, with a debtor's age analysis, obviously a business is going to monitor its outstanding debtors and they're going to have a list. They're going to have certain amount 30 days outstanding, certain amount 60 days outstanding, another amount 90 days outstanding. So when you're looking at analyzing your debtors, okay, when you have something like this where they've actually split it, they've given you an expectation, they've told you that I have sold goods, okay? The total sales amount to 1.5 million.
No.
Right. They say that 30% of their customers usually pay on the 10th day and take the
Yes.
discount. Okay. So if I'm looking at that, do you agree? Okay, we need to calculate that portion based on what we've read, and then the 70% we also need to calculate based on the thing that we've read. Right. If it's after 50 days, do they get the discount? No, they don't. If it's within 10 days, then they get the discount. Can you see that?
Yes.
All right, so let's go to the answer and let me show you what I did. This is the long question, eh? Here, this one. Okay, there you go. So let's just make it bigger so you can see it. Right, question 1. Right, notice I've got a formula for average collection period. Remember, equations are important. You've seen them before. Okay, it doesn't really matter how you write this down. You can write it as is, or you can also write it like this. Trade receivables divided by the sales, the credit sales, times 365. Okay, that's also fine. All right, if I divide by divide, I'm multiplying actually. So you can decide, okay, you can leave it like that or like this. It doesn't really matter. Okay, you read the question, you had 1.5 million. We just saw that. Okay, go back to the question. Remember, they said this was the total sales for the year. Okay, so every month I'm going to have a portion of that. Right, because remember, 1.5 is for the whole year. So on average, if I divide that by 12 months, I'm going to get 125,000 per month. Right, if I'm looking at what they said in the question, they said 30% is going to pay on the 10th day and take the discount. 30% is going to pay after 50 days, right, after their purchases. And we can assume a 365-day year, and all the sales are on credit. So if all the sales are on credit, you have to take out any cash. Right, so if I'm just looking at the months, I'm just showing this just so you can see it, okay? If I sell something in October, right, that means I'm going to collect in November, and I'm going to collect in December. Okay, so if I'm looking at the current situation, I've got 70% received in Jan, so that times 70%, okay, gives me this figure, okay. I'm multiplying it by 2, let's just check this, because of the 2% discount, okay, 2 divided by 10, because of this, it's the 10th day, right. Let me just see here. Oh, okay, I see. All right, because they said on average. Yeah, okay, on average. Right, the other 70% pay on average 50 days after their purchases. All right, so when you have an average, you have to take the before and the after, the start and the end, divided by 2, okay, to calculate an average. All right, so when you're reading this, they tell you that the other 70% on average, okay, 50 days after their purchases were made, right, and 70% pay 50% after, 30% usually pay within 10 days and take the discount. Right, so the question here, let me go back to the question first. Calculate the firm's average receivable collection period. Okay, so if I'm looking at the average receivable collection period, I need to know what the total receivables are divided by the annual sales. Okay, so if I'm looking at the ACP, I know what the annual sales were. That was given in the question. Okay, I need to get the average collection period. So collection period is the debtors. The debtors is the portion that will be outstanding at the end of the period. Right, so if I'm looking at this situation, what don't I get? 70%. 30% pay me, 70% don't pay me. Do you see that? Okay, the other 70% on average, 50 days, on average, 50 days after their purchases were made, right? So that means that 30% of the total is paid for and is collected within the 10 days after applying a 2% discount. The 70% pay after the 50 days, okay, which is after the discount period, so net 45. Right, so if we're looking at how much trade receivables do I have available, I've got per month, so every month, so in every month, I'm going to have sales of 125, okay. I'm looking at how much of that do I have that's left over, okay. So 30% pay, okay, and then 70% pay after 50 days, all right, so two times that amount, okay, is outstanding at the end of that period. So after the period, okay, 30% paid, 70% remaining. Okay, that 70% remaining is only payable after two months, 50 days after. So 50 days. So if I'm looking at 50 days, if this was day 0, maybe just add more workings just so it makes more sense. Day 0, this would be day 30, and this will be day 60. Right, so when I'm looking at the average collection period, I'm calculating how much trade receivables do I have for that period divided by the annual sales. Right, so that's why I've got the annual sales, so the 1.5 is there. This is the portion that I had to calculate. Okay, that portion is calculated based on what they gave you in the question in terms of your interpretation. Because at the end of the period, how much debtors do I have available? Okay, so when I make a sale, I'm not going to collect any of it. Okay, I will collect 30% of it, and there will be 70% of it remaining. So 70% will be received later on. Okay, day 60. Okay, so day 50 is when the 70%. Okay, on average. All right, 50% of it is collected at that point.
Confusing me is
right, so if I'm
it
looking at the receipt or the amount that's outstanding, all right, 2 times the 70%, 70% and 70%, so that's why I've used twice the amount as the trade receivables, the amount that's representing the outstanding debtors portion. I don't know if that helps.
The part that's confusing me
Yeah.
is timesing it
By 2, yeah, because there's 2 portions of it. Let's just go back and see. Because it's begin and end, because it's the average, the other 70% pay on average.
Yes.
All right, so on average, when you get an average will always start plus end divide by 2. Okay, so when you calculate an average, so in some measurements, when you calculate an average, you take the start plus the end, and then you divide that by 2 as a working. I don't know if you remember that from any of the previous calculations.
Yes.
Okay, so if I'm calculating the average, okay, it's 2 amounts together. So if I'm dividing it by 2, so 140 would be 70 and 70, basically.
Yes.
Yeah, so I'm just trying to work out the actual amount, not the average amount.
Okay.
Okay, let's just read this again. The other 70% pay on average 50 days. Yeah. So on average meaning it's not all of them are gonna pay. Okay. On average, they pay 50 days after their purchases were made. Right. It is a very short question. I would have expected a lot more information. They probably gave more information later, did they? Not really. There's a little bit here, 45 days, but there's not a lot. Okay, here they've given more, but this is a different question. This is EOQ. All right, so in terms of debtors, this relates to debtors. There's the credit policy thing. Oh, but that's a separate working. Okay, very similar to what we just did. Calculate the average amount of trade receivables for this firm. Average amount of trade receivables, so that's the average amount. This is the calculating the trade receivables for the period. So that's the period, and that's the average amount. So let's look at the next one. Okay, average, your ACP, okay, divided by 365 times 1.5 million, 175. Let me find something in the textbook here.
That I was struggling with.
Let me just see. This came from your debtors collection.
It's got to do with seasonal and seasonal funding.
Okay, while I'm looking for it, any other questions?
Okay.
There is a multiple choice question that I was struggling with. It's got to do with seasonal
Yes,
and
And
seasonal funding.
yes, okay, we can look at that. I found it here on page 624. If you look at the top, here they're talking about trade receivables. Okay, if you look at the example, so the example starts on page 623 in the, what edition is this? Second edition. Okay, Gitman,
yes.
Principles of Financial Management. Okay, example 16.1. If you look at this, have a look. They said G company has annual sales. They've given you that total. Then they've given you the cost of goods sold. They've given you the trade payables. And then they say G has an average inventory. Okay, AAI, there's the AAI given. And then they've given you that ACP. Okay, and they've also given you the APP. Okay, the average collection period as well as the average payment period. Right, then they tell you that the purchases were this, thus the cash conversion cycle is that. So they've worked out the cash conversion cycle. Here that wasn't given, but you do need to calculate it. So have a look at the work on the next page. If you look at the trade receivables, right, in order to calculate your trade receivables, you've got to take the amount that's given, multiply it by the average collection period, and divide that by the 365. See, average debtors, okay, whatever the ACP is, okay, take the ACP, divide by 365 times the amount that's given. That gives you the trade receivables portion, right? And then they even say here at the bottom, where's the note here? There, based on the G's APP, okay, that's APP, let's look for the ACC. Okay, they're talking about APP here, not not the collection. They just talked about the cash conversion. They didn't comment about the ACP. I see they've only commented on the APP. All right, but yeah, that's one that's looking at your average, or not average, but the year, the grossing it up. So taking or working out a portion of it based on the total.
Okay, so that is, yes, it's
Yeah, let me
question
see if there's
24
anything
multiple
else.
choice.
Okay, that's the one I can find. Then the cost of giving up discount, that's different. And then you've got the payables, that's also separate. Okay, all right, let's look at the cash, not cash, let's look at the conservative, aggressive, the funding thing. Is it this paper?
Okay, so that is, yes, it's question 24 on multiple choice.
Okay, there's it there. All right, so
Yes.
okay, perfect. All right, so remember when you're looking at seasonal and permanent, okay, to calculate seasonal and permanent, you need to look at what the fixed is. So the
They do,
fixed
yeah.
is 100, right?
Yeah.
Okay, you can see the total assets. That would be the total financing. Let's just read what they say here. The firm earns, okay, so this is the rate that they can earn the current assets, fixed assets. Okay, so this would be used depending on whether you're looking at a aggressive or conservative strategy. Okay, they don't want that here. Oh, they do want that in the next one. Okay, yeah, in the next question. All right, so the first thing is the average seasonal funds. Okay, remember, seasonal is going to be looking at the difference. Right, this is an example that came from your notes. Let me show you this. The seasonal funding.
I know the notes on page 52, the notes. Yes.
Where's that diagram? Ooh, what page is the diagram on? Do you remember the diagram with the permanent seasonal? What page was that? What section was it?
52, the notes.
52.
Yes.
There we go. Okay, good. Yeah, so page 558, if you go to page 558, okay, if you look at that diagram that they've given you, all right, here you can see the permanent need is the minimum, the line. So if I had to draw this picture for this question, let me show you what will it look like. Okay, it's going to look like this. Okay, the permanent is going to be 100. Okay, then you're going to have these fluctuations.
Okay.
Okay, those fluctuations. This is looking at the fluctuation, in other words, the difference. The highest point is the total. Okay, so the seasonal bit is those differences. So here, you've got the 45 and the 100 giving you the 145. Okay, this is the fixed portion. That's the seasonal bit. So this is what we're looking at. Okay, so if you look at the working, wrong page. There we go. Okay.
Okay.
All right, have a look. Okay, what is the peak? All right, the peak is the biggest amount, the total. The peak here is the 175. So the highest point happens in December. Right at December, there's 175,000. That's the highest point. All the other points are lower than that. That's the peak. Okay, when I'm looking at the peak, I need to look at what the permanent is. Okay, so permanent is the fixed is 100,000. If I bring in all of these additional amounts, I've got 140, which is the lowest amount. Okay, so the lowest is 140. Right, if you look at the diagram in the textbook, let me take you back to that example, 500 and, page 588. Right, if you read the question, okay, they tell you that the company holds on average 50,000 cash, okay, 1.25 million inventory, and 750 trade receivables. Right? They also tell you that if you're looking at their peak,
So it's
if
the
you continue
lowest
reading, they
point
say at
of
peak
total
times,
assets.
S's inventory increases to 750,000, and its trade receivable increases to 400,000. Right. So if I'm looking at the permanent is
Yes.
the basis, the lowest point. Right, so in this case, the lowest point, did they give you a table
Yes.
here? No, they didn't. Okay, they haven't drawn the table.
The lowest point of total assets.
It's the lowest point, in other words, what you need as a basis. Right, because the current is the seasonal portion, but because I've got fixed and current, that's giving me my total. Okay, so the lowest point is actually 140. The seasonal would be the difference. Yeah, the working is correct. This needs to be 40,000. 140. Right, because that's the lowest point, taking your current and your fixed into consideration, because it's the total. Let's just read this again. Yes, S's total funding requirements for the operating assets vary from a minimum of 135 to a seasonal peak of 1125, which is the 135 plus the 900,000, which is the total. Yes. Okay, so the lowest point in this example is the 140, and the highest point is
Yes.
the 175. Okay, so if I'm looking at the seasonal, this is 140, so I need to subtract 140 from all of these. So 145 minus 40 is 5.
Yes.
That's 0. That's 10.
Okay.
That's 15. That's 20. And
Okay,
that's
now I
35. Does that make
understand.
sense? Okay. Those amounts, if I add those amounts together, add those amounts up, so 1, 2, 3, 4, 5 gives me
Okay.
85,000. I'm dividing by 6 because the 1 month was 0, hey? July to December, that's 6 months. Gives you that figure. Option 2.
Okay, now I understand.
Yeah, so it's just this, the permanent. The
Because I
permanent,
thought that the permanent is the 100,000.
the permanent
the
is the
fixed.
lowest amount. Okay, it's in line with the textbook. They just didn't give a table here. They
Yes.
gave a diagram. Yeah, so on the diagram, they said that their minimum required amount was the 135, which was the permanent need.
Okay, so I thought that the permanent is the 100,000 fixed assets.
No. Okay, because if you look at, remember, the fixed assets and the current assets both are going to make up the total assets. Okay, so even if you look at this example, have a look at it on page 588. Here they said the short term is 100,000, that's inventory, and then you've got 60,000 trade receivables, and there's cash of 25,000 short term investments. Okay, so 100 plus 60 is 160, less 25 is 135.
Okay.
That's the permanent. Okay. All right.
Okay, maybe the next question.
Yeah, good question.
25.
It's good that we're looking at that. That also comes up quite often where they talk about these funding requirements. So just remember it's highest point, lowest point. Seasonal is the in-between.
Yes.
Okay. Good question. Anything else? Let's take one more question. What else do you have? Anything else that you're struggling with?
Okay, maybe the next question, 25.
Oh, okay. So when you're looking at the
Yes.
funding, aggressive means I'm going to have long term and I'm going to have short term. Remember that. Okay, conservative means I'm only going to have long term and the long term is going to finance everything. So in other words, the full amount. Okay, when it's aggressive, the short term finances the seasonal and the long term finances the permanent. Does it make sense?
Yes.
Okay, so seasonal portion is what we just worked out. Long term is the permanent. There's what we just worked out. See that? Okay, the only thing we need to do is we need to bring this in. Okay, so we need to bring in the rates. Right, I'm looking at raising capital, finance. Right, so the funding is the important point. I need to use the 13% because that's short-term financing.
Okay.
Okay, this is financing. This is getting capital. Okay, so if I get short-term capital will be a current liability. So 13% would be the rate that I would use. Okay, long-term
Thank
financing, long-term funds, 17%. Okay, so in this example, long-term financing is a bit more expensive than the short-term financing. They're both looking at acquiring or getting capital.
No, it
Right,
would
so if
be
I
less
add up those two
confusing.
amounts, I get this. I see the amounts weren't perfect, but they're rounded off. So if you round it off, you'll get the right answer.
Yes.
Okay. I don't know why they don't give round like equal answers. They say approximately equal to. I don't know why. That's weird.
Yes.
Okay, approximately equal to. It's strange. Okay, just give the right answer.
Do you perhaps have more past year papers that I can go through?
Yes, but remember these are old papers, so hopefully by now they've improved things. Yeah, it was very
No, I
like strange.
don't.
Like it's like okay, this is correct, and then this isn't. Like it's
No.
weird. Yeah,
Yeah.
it's strange. Okay, and then like why approximately equal to? It's very strange. Yeah. Okay, but it is what it is.
Anthony,
Yes.
do you perhaps have more past year papers that I can go through?
No, I don't. So if you've got more, you can send them to me. Like, yeah, because it just depends. Like,
Okay.
oh, you don't? Did they not give out any this year?
No.
Yo, that's weird. They normally should. They normally post a few. So depending on when I help students, then they'll give me what is available on UNISA. So generally, UNISA gives past papers on your My UNISA portal. So that's how I've managed to get these older past papers from students in the past that have asked me for help. Yeah, I think the newest one
But I'll double check on
was
UNISA
the
just to
18
check.
one. Yeah, and then I think they
Yeah.
might have stopped giving papers after then. Yeah. Okay. All right. Yeah, that's what I have in my like question bank. If you do have more, you can send them to me. I don't mind looking at. Or what you can do is maybe if you've got a paper, maybe I recommend doing the paper and then sending it to me. Then I can check it. That's fine. That's not a problem.
But they shouldn't,
If
because
you've got
like
others.
especially with modules
Yeah,
like
check
this,
on
you
my uni.
need
So they
to
normally do give out
go
some.
over,
It's
just
normally
it
closer to the
helps
exam
you.
time. They should give
Yeah.
you papers. If they don't, you should be able to request them. I don't know why they're withholding that information. It's a past paper unless they're
Yes.
using like test questions again, and maybe that's why they've stopped giving out past papers.
But they shouldn't, because
Yeah.
like
Yes.
especially with modules like this, you need to
Of course.
go over.
Yeah.
Just
Yeah. No, I
helps
agree.
you.
I do
Sounds
agree.
good.
It's important to give more workings. I know that what is it that what do they call it? The tutorial letter or the study guide, right? The one that you sent, I think that has improved quite a bit. Here, let me see the 2023 study guide, the one that you sent. I think you might have more questions there. Maybe they've incorporated in
Yes.
this book. Because this book before used to be tiny. Now it's a lot bigger. I mean, it's 102 pages long. So if I'm looking at
Yes.
something like aggressive financing, let's see if we can find one here.
Okay.
Yeah, here we
Yes.
go. Okay, here's a good example. All right, there's the current assets, there's the fixed assets, there's the total assets. See that? Okay, so
Yes.
if you're
Yes.
looking at these amounts, your permanent funding would be the smallest amount,
Number
which
of
is this one,
months. Yes.
the 110. The biggest amount is the 130. So if you had to draw a diagram,
Yes.
okay, yeah, there's the permanent, see?
Okay, yes.
And then the seasonal would be the difference between your total and the permanent. So 130 minus 11 is 20, same as what we just did.
Yes.
Okay, and then notice divide by 6. I divide by 6 because it's the number of months. Right, 1 month was 0 because of the permanent. Okay, yeah, so
Yes.
yeah, this is fine. See, and then the permanent funds, seasonal funds. So if you're looking at the aggressive financing strategy, aggressive means raise capital. The permanent needs will be raised using long-term
Long-term
financing.
financing.
The
Okay.
seasonal needs will be raised using short-term financing. In this question, the short-term financing was 6%, long-term financing was 12%. See?
I think
Okay, that's
it's
what they've done there.
conservative.
All right. And then
Oh no,
conservative,
sorry, I was looking at
everything,
all
all of
three
it. So
numbers
literally
on
the
the top.
total,
Yeah, it's actually
everything. The
yeah,
130
the
is going to be
triple.
raised by long-term financing. Yeah. And then just remember, if they ask you a question like this, you need to compare. Which one is
Yes.
cheaper here? Is conservative better than aggressive? Which one's better? Looking at this question.
I think it's conservative.
No. Here the cost is greater.
Oh no, sorry, I was looking at all
Okay.
three numbers on the
Yeah,
top.
you have to look for the cheaper one. Okay, total required funds, it's going to be cheaper to raise capital
Incorporated it.
using the aggressive financing
Yes.
rather than the conservative.
Yes, it does.
Okay, yeah, but it's always looking at cost. Remember, this exercise is looking at costing. It's looking at getting enough capital and paying off the interest or financing that capital. All right, so
Okay.
maybe that's why they haven't given as many past papers now, perhaps, is because maybe they've incorporated some of it into the study guide, yeah. Because I see the study
Yes.
guide also has multiple choice. Look at that.
Yes.
Yeah, so they've done a good
Cool.
job
Thank you very
at
much,
improving the
Anthony.
study guide. Before, the study guides were very, very thin,
It
a
is.
lot thinner than what you've been given, and not as detailed. They have improved that quite a
Yeah,
bit,
no, it's
so
all
they have
online.
done quite nicely here. All right, so maybe use some of these questions as a test yourself. Like literally, like pick an option and then go mark it and see it. And like use it as like a test. Use it like an exam. That can also help prepare you. Okay, but I think you said it's an open book, right? So it's still online, right? There's no more exam venues and you go in and write and stuff like that, eh?
Thank
Okay.
you.
All right. So then my best tip for you is just to
No,
bookmark
obviously
questions,
just
bookmark similar
go
questions,
through everything again,
maybe
go through the
highlight
questions again,
key
but
formulas,
I think
like
I'll be okay.
templates. And then
Thanks
once
to
you've got
you.
all of that, then in the exam, you can just reference what you need when you need it. And then you can just apply the same
Thank you.
approach and then you should do well.
It is.
Okay.
Yes, so
Awesome.
it is on
Anything
the
else? Final
Friday, but it's
thoughts,
just that I
comments before
have
we wrap
like
up?
3 exams in that whole weekend, so
No, obviously just
yeah.
go through everything again, go
Yes.
through the
It's investment
Yes.
management.
I think I'll be okay.
Yes,
Awesome.
one.
All right.
Thanks to you.
Yeah, no, you're welcome. Thank you for
Yes,
letting me
I've
help
been
you. It's
through
always a
all the
pleasure.
videos, and
I wish you all the
at the
best with
moment
the
I'm
exam.
going through the
If I
exam
remember correctly, I think you
papers.
said it's in 2 weeks, eh? So not
So
next week, but the week after, on the
one or
Friday.
two are a bit
Something like that, eh?
challenging,
Yes,
but
it is on the
obviously I'm
Friday,
just
but
gonna
Okay.
it's that
keep
I have like three
going through
exams
it.
in that whole weekend.
Yeah, it's going to be a rough week. Shame.
Yeah.
What are the other exams? What other modules are you doing?
It's investment management.
Oh yes. How is that going?
Yes.
Did you manage that course?
Yes, I've been
Okay.
through all the videos, and
Yeah.
at the moment I'm going through the
Yes,
exam
yes.
papers.
Okay, that's good.
Yeah, but thank you